Li-Gang Liu, thank you very much for joining me. Starting first with global growth, the IMF today has revised its outlook down to the lowest growth rate in a decade. How do you see the global economy and where we're headed?
Yeah, indeed, the Citi views is quite consistent with the IMF one. That is, we think global economy is slowing down. If you look at developed economy versus developing economy, the developed world probably will slow down more at the margin than those EM countries. China basically is also slowing down. We will see China's Q3 GDP data. Our current forecast is 6.1%. And Q4 we have the same number, 6.1. So for the year as a whole, China's growth will slow to 6.2%, 0.2 percentage point lower than the previous year, right? So this suggests that the biggest contributor to global growth, China used to contributing around 30% of global growth. Now it is slowing down as well. That will drag down some of the economy in the world as well. In particular, we have been seeing that ASEAN growth is also slowing, and European economy to some extent, certain countries like Germany often being positively affected by the Chinese economy now is also slowing. And so this broad trend run the risk that after 2009, whether the global economy may enter into another period of economic slowdown. But I want to mention that to some extent this slowdown is very much man-made. If there's no China-US trade war, perhaps the global growth at this moment could be still rather healthy.
Moving to the US-China trade war, what impact is this having on global markets?
Well, this trade war has made global corporates difficult to decide where they will put their investment. And China used to draw a lot of foreign direct investment from United States, Europe, or even regional economy in Asia, right? Now we do observe that FDI going to China is slowing, right? And at the same time, this tariff issue is affecting the sentiment of consumers. We see that vividly in the Chinese economy. And if you look at Chinese retail sales, it has been slowing to around 8% growth against last year's still close to 9.5% growth. And even China gave consumers a big tax cut. We did not see much boost on durable consumption, suggesting that this uncertain environment has made consumers quite cautious. So that's something is slowing or dragging China's growth. Thirdly is the sentiment, right? Whenever we hear this trade war escalation, global equity market tend to tumble, right? So I think as long as we can get rid of this uncertainty, perhaps the global economy, including Chinese economy, won't fall into the potential trap of a further slowdown.
And how do you see it playing out?
Well, so far, as I mentioned, it has affected sentiment the most. There's a lot of talk that whether the supply chains located in China will move out of China quickly and in large drove. On that, we did see various media reports about plant closures, especially led by US and Taiwanese firms operating in China. But on this very issue, we recently put out two research notes. We think that if you dig into the data, the supply chain move out of China may not be that fast and soon. And the main reason is that, if you look at China's labor productivity, since it's entering into the WTO, China's labor productivity has risen by 4.2 times. Out of emerging market labor force, the Chinese labor, productivity is still one of the highest, right? Secondly, China has a very efficient infrastructure built over the last 30 some years, and Chinese local governments are still very good in providing policies to attract foreign investors. Thirdly, if you look at China's industrial completeness, and basically, China's market will allow those foreign invested firms to source most of their needs within China, and so that's another draw. Finally, I think in terms of potential investment needed for the ASEAN region or elsewhere, will be fairly large in order for them to replace Chinese export to the United States. So in that sense, I think the supply chain will gradually move out of China, but the impact on China's economy should still be manageable. Our numbers suggest that perhaps this supply chain moving out will create maximum 5 million job losses in China in 2 to 3 years. Given Chinese economy is creating around 30 million jobs per year, and this unemployed population owing to supply chain outshift can still be manageable.
How concerning is slowing growth in China to countries like Australia?
If you look at China-Australia economy, and the two economy has moved closer together, right? China definitely is Australia's biggest export market. Increasingly in the services sector, Chinese students studying in Australia and tourists are affecting a lot of non-tradable sector, that is the service sector. And so this slowdown, together with renminbi depreciation, probably will mean less imports from China and less tourists and students arrival in the Australian economy. And as a result, Australia may not benefit from this kind of trade tension between China and the United States. But I'm rather confident, given Australia's good fiscal conditions, there's a lot of fiscal room for the federal government to stimulate the economy should Chinese economy continue to slow down.
What is your view on central banks around the world, including Australia, to move towards lower interest rates, some even negative interest rates?
Well, we all know that for those central banks already in the negative interest rate territory, it suggests that they have run out normal monetary policy tools. And for those economies, we economists tend to think that without fundamental structural reform, the only monetary policy tool will only do little to help the economy. In economic theory, there's a convention, understanding that is monetary policy can only pull the economy, cannot push the economy. And so as long as the fiscal policy is very much constrained, if the economy is unwilling to engage in fundamental structural reform, what monetary policy can do could be very limited. And so this basically sends a very important signal to those emerging market economies. If they want to maintain sustainable growth, perhaps the government need to focus on the more important part of the policy initiative. That is how to engage in structural reform so that their economies can regain competitiveness. In the case of China, I think although China still has a lot of monetary space, if you look at triple R for large banks, it's still at 13%. Chinese central bank also has more room to cut interest rate, especially other major central banks have been cutting rate. And my view is that China also needs to focus on the very necessary structural reform. Number one priority should be the SOE reform. If China can move towards mixed ownership reform on SOE, that will help address SOE sector high debt problem. And with this diversified ownership, perhaps the SOE's corporate governance will improve, incentive could change, the SOE sector could become more productive in the economy. And so that's something I think, even for an economy is still growing at around 6%, China need to look at its structural impediment because over the last 10 to 15 years also, China's structural reform has been lagging behind.
Here in Australia, we're at historically low interest rate levels. We're starting to talk about a future of quantitative easing. What are your views on QE? Do you think it's warranted?
Well, it really depends on the economy. I would say perhaps QE has worked reasonably well in the United States. But if you then look at the U.S. Policy response after the global financial crisis, the Fed, the Treasury has reacted very quickly on the potential non-performing loans in the banking system. And U.S. has done a great job in resolving the high debt problem in the household sector. And you can see that the reason U.S. QE worked well is that a lot of structural changes have been undergoing, right? Whereas QE in other part of the world, such as the EU economy, we have not seen significant impact. The main reason that perhaps the European economies, for lack of strong leadership, because in the case of EU, there's a monetary union. On the fiscal side, each sovereign government can run its own fiscal policy, and perhaps the incentives to engage in aggressive structural reform has been lacking. We have not seen a significant impact from ECB's QE on the European economic recovery, right? So I think it's really conditional on a lot of things. It's difficult to just brand it's going to work or not going to work. But overall, I think the QE probably has made the last global recession less painful. But this does not mean, after this global recession, major economy can grow at their potential growth again, without engaging in, the necessary structural reforms.
Li-Gang Liu, thank you very much for joining me.
Thank you.